What's up, guys? Welcome to the Cash Craft, your daily dose of finance and technology news and updates. Hudson Pacific Properties just sold $330 million in real estate and completed over $2 billion in capital transactions in a single year. That nearly doubled their liquidity. So why does the company still feel like it's fighting for survival? Because in commercial real estate right now, staying alive means moving fast. Hudson Pacific isn't celebrating those numbers. They're using them as ammunition. The question isn't whether they made smart moves in 2025. It's whether they made them soon enough, and whether the market they're betting on will actually recover. Let me show you what's really happening here, because this earnings call reveals something most people miss about how distressed real estate companies try to turn themselves around. Hudson Pacific operates office buildings and studios, primarily on the West Coast. That's important context because West Coast office real estate has been in freefall since the pandemic reshaped how people work. Empty towers in San Francisco and Los Angeles aren't just a headline, they're Hudson Pacific's daily reality. So when management announced they'd completed $330 million in asset sales during 2024's fourth quarter, they weren't bragging about profit, they were demonstrating something more fundamental: the ability to find buyers at all. In a market where office buildings are trading at steep discounts to what they were worth 3 years ago, liquidity itself becomes the victory. But here's where it gets interesting. That $330 million was just one piece of a much larger puzzle. The full $2 billion in capital transactions management referenced included refinancing, debt restructuring, and strategic sales across their entire portfolio. Nearly doubling liquidity wasn't about growth. It was about creating breathing room. Now, pay attention to this next part, because it explains the real strategy. Hudson Pacific isn't trying to ride out the storm with their current assets. They're actively reshaping what kind of real estate company they are. The asset sales weren't random. They were surgical. Management is shedding properties that face the steepest headwinds while concentrating capital on assets they believe have a path forward. The studio properties, for instance, represent a different bet than traditional office space. Streaming demand might fluctuate, but content production isn't moving to remote work the way legal firms and tech companies did. That's a distinction worth hundreds of millions in valuation. What most analysts miss in these earnings calls is the timing pressure. Hudson Pacific isn't operating on a 5-year turnaround timeline. They're operating on a refinancing calendar. Commercial real estate debt comes due in waves, and 2026 and 2027 represent a massive wall of maturities across the industry. The companies that shored up liquidity in 2025, like Hudson Pacific just did, are the ones that get to negotiate from a position of strength when those loans come due. The ones that didn't are the ones that hand keys back to lenders. Here's what nobody's talking about. This $2 billion in capital transactions might look like financial engineering, but it's actually a test of market confidence. Every dollar Hudson Pacific raised or refinanced represented a counterparty, a bank, an investor, a buyer, making a bet that this company survives. In distressed real estate, the ability to transact at all is a signal. It means the market hasn't written you off yet. The real question is whether Hudson Pacific moved fast enough relative to their peers. Commercial real estate operates in a herd. If you're the first to sell assets in a down market, you get hurt on price, but you get liquidity. If you're in the middle of the pack, you get both bad prices and competition for buyers. If you're last, you get neither buyers nor liquidity. Hudson Pacific's 2025 moves suggest they're trying to be early, not late. But there's a darker possibility embedded in these numbers. What if doubling liquidity still isn't enough? What if the West Coast office market deteriorates further, and even the properties Hudson Pacific kept start losing tenants? Liquidity buys time, but time only matters if the underlying business stabilizes. Management is betting that by 2027 or 2028, office occupancy trends will flatten or reverse. That's not a guaranteed bet. It's a calculated gamble with billions of dollars on the table. The bigger picture here is about survival math in commercial real estate. Hudson Pacific's earnings call wasn't about celebrating a strong quarter. It was about demonstrating to creditors, investors, and the market that they have the financial flexibility to make it through the next 18 to 24 months without a forced liquidation. In this environment, that's the only metric that matters. If you're watching commercial real estate right now, the question you should be asking yourself is which companies are actually solving for liquidity versus which ones are just talking about it. Hudson Pacific put $2 billion in transactions on the board. That's not a promise, it's proof of execution. But execution in 2025 doesn't guarantee survival in 2027. It just keeps you in the game. Personally, I'm watching how many of these capital transactions were true asset sales versus refinancings. Real liquidity comes from converting property to cash, not just extending loan terms. If Hudson Pacific is actually finding buyers at scale in this market, that tells me something important about where institutional money thinks the bottom is. That's all for today, folks. If you found this helpful, make sure to like and subscribe to The Cash Craft for more finance and tech news. Drop a comment below with your thoughts, and I will see you in the next one.